My name is Jake, welcome to the channel. Have you ever wondered why dividend investors love talking about Johnson & Johnson? If you've ever read an article on the best high quality dividend stocks of 2020, 2021, you'll notice that time and time again, Johnson & Johnson is appearing on those top lists of dividend companies. And there's a reason why Johnson & Johnson is really a fan favorite among many dividend investors and dividend growth investors. The goal of this video is to help you understand why dividend investors love investing into companies like Johnson & Johnson. In my M1 Finance portfolio, I also own Johnson & Johnson. It doesn't make up the largest position in my portfolio, given my wife and I's time horizon of when we plan on living off of the dividend income from our portfolio. Even if it's not my largest position in my portfolio, it is a strategic core position in my portfolio. So the goal of this video is to help you understand why dividend investors love investing in a Johnson & Johnson and help you make the right decision if Johnson & Johnson is a company that you may want to consider for your portfolio. So first, we're going to talk about the history of dividend increases. Second, we're going to talk about the diversification that you get with investing into a business like Johnson & Johnson. Third, we're going to talk about the competitive landscape and the competitive moat that comes with Johnson & Johnson. And then fourth, I'm going to dive into a brief fundamental snapshot and take a look at how Johnson & Johnson has been performing over these last couple of years. And then lastly, we're going to take a look at the historical performance and expected future performance of Johnson & Johnson using the FASTgraphs tool, the fundamental analyzer software tool. It seems like every dividend investor has an opinion of Johnson & Johnson or any other dividend company out there. But what I tend to notice is when you read the comments about Johnson & Johnson, the company, typically people are really in favor of Johnson & Johnson, or they're a little bit skeptical. They're not so bullish because it's such a slow grower. But it's so entertaining to read the comments on Johnson & Johnson. It usually looks a little like this.
I am sick of all you guys ganging up on me. You guys all think you're so much better than me.
Oh, Meg, that is the least fancy thing I have ever heard.
The first reason why dividend investors love Johnson & Johnson is because Johnson & Johnson belongs to an exclusive group of dividend stocks. A company that has increased its dividend for 50 consecutive years, Johnson & Johnson is a Dividend King. In fact, Johnson & Johnson has been considered a Dividend King for over 9 years now. There's only a very small handful of other companies out there that have a longer track record of dividend increases or consecutive increases than Johnson & Johnson. The reason why dividend investors love this great track record is it means this business is able to manage its cash flow. The cash flow is what pays the dividend. And if the company is able to generate cash and pay that out to shareholders over this long of a time period, almost 60 years, it means that a lot of things are going right for Johnson & Johnson. Another reason why dividend investors love this long record or track record of dividend increases is because if you're a long-term investor, your yield on cost is just snowballing. So for example, if you were to buy into Johnson & Johnson today at the current prices, you would have a starting yield of just over 2.5%. Now let's imagine, for example, that you invested in a Johnson & Johnson 5 years ago. Let's say you invested $1,000. That original $1,000 that you would have invested 5 years ago, today is yielding over 3.5%. Now, if we were to even go back even further, let's say you were to invest $1,000 10 years ago, that initial investment of $1,000, you would be yielding just over 6.5%. The longer that you're investing into a business like Johnson & Johnson, the more your investment is going to compound over time. That initial investment of $1,000 is yielding 6.5%. Compared to if you were to invest today, you're getting 2.5%. So time is really your most valuable asset when investing into a business like Johnson & Johnson. And if we were to go back, let's say we went back 20 years. If you were to invest in a Johnson & Johnson 20 years ago, you'd be yielding just around a 9% yield on cost. And this is the magical thing about dividend growth investing, is that initial investment that you invest into a business like a company like Johnson & Johnson is going to snowball and grow over time. Now, the dividend growth of Johnson & Johnson has not been as high as other maybe technology companies over the last 5 and 10 years. If you've been investing into Johnson & Johnson, you've seen an annual dividend increase of about 5 to 6% over these last 5 to 10 years. Now, 6% dividend growth rate is not the highest. A 6% dividend growth rate is, I would say it's good, but it's not great. But I think there's an important thing to factor in when you're looking and comparing the dividend growth rate of Johnson & Johnson and maybe another company or another sector in the market, like a technology company, for example. Now, let me explain what I mean by that. So if we look over time in the S&P 500, right? Back in the 1980s, the S&P 500 looked very differently than it does today, right? You have a handful of oil companies here and a telecom company that made up the largest positions or weighting in the S&P 500, right? You don't see Johnson & Johnson on here. You don't see Microsoft. You don't see Apple. You do see IBM. Let's say, for example, in 1985, yeah, there's not a lot of things changing. GE is coming up, right? Now let's look at 1990. In 1990, you have some new players in the market, right? You got a pharmaceutical company. You got Walmart. You got Coca-Cola. If we fast forward into 1995, you can see, okay, you got Johnson & Johnson, you got Procter & Gamble, and here you see that Microsoft is really starting to pick up pace. If we look at 1998, just a couple years later, Microsoft is the largest position or the largest market cap stock in the S&P 500. If we look at 2002, you can see that Johnson & Johnson is part of that top 10. And if we look at 2008, you can see that Johnson & Johnson is still on that list of top 10 weighted companies in the S&P 500. And if we were to fast forward to today, Johnson & Johnson is not part of that top 10 in the S&P 500. You can see that the top companies in the S&P 500 are skewed heavily towards technology companies. Microsoft, Apple, Amazon, Alphabet, Facebook, Tesla, Nvidia, all really hyper-growth technology companies. And then you have your Berkshire, you have your JP Morgan, and at number 11, you have your Johnson & Johnson. And so what do I mean by this? When we're talking about the dividend growth rate, if you know your history, in the last 10 years, we've seen an explosion in technology companies. And healthcare companies have really not been thriving nearly as fast as technology companies. So when I look at this dividend growth rate, I kind of look at that with a grain of salt because it really depends on what time period you're looking at. The last 10 years have all been about tech. It's all been about growth. As we know, the market goes up and down in cycles. And so I believe over a 20, 30, 40, 50 year time horizon, I think you're going to see a company like Johnson & Johnson have very comparable growth rates to some of the largest and best technology companies out there over an extended period of time. But obviously I don't have a crystal ball, so I guess time will only tell. Now let's take a look at the second reason why dividend investors love investing into a company like Johnson & Johnson. Johnson & Johnson is a company, is pretty much an ETF in its own. When you think about Johnson & Johnson, there are so many different brands and products that are under the Johnson & Johnson umbrella. Similar to other companies like Procter & Gamble, PepsiCo, Coca-Cola, these parent companies own dozens, if not hundreds of subsidiary businesses. And so when you invest into a company like Johnson & Johnson, you're getting instant diversification. By investing into Johnson & Johnson, you're investing in their 3 business units. Their first business unit is in pharmaceuticals. Their second is in consumer goods. That's probably what the majority of you and I are familiar with, right? If you've ever taken Tylenol for a headache, that's Johnson & Johnson. And then third, medical devices. To truly understand the diversification that you get with Johnson & Johnson, it's important to understand how they're set up geographically and by business unit. If we take a look at their annual report in 2020, you can see that just slightly over 50% of Johnson & Johnson's revenue was generated in the United States. And so what that means is just slightly under 50% of their overall revenue was generated outside of the United States. So you might think to yourself, well, I need to invest into companies that are 100% international. Well, in fact, if you invest into a business like Johnson & Johnson, you're getting instant international exposure, but you're getting that without the currency risks that are associated with that, the fluctuation in currency prices. And then second, over here, you can see how they're diversified by their business unit. Pharmaceutical makes up over 50%, followed by medical devices, and consumer health. So what that means is when you as a consumer go to Target or CVS, for example, here in the United States or international, and you purchase Tylenol, that's what you see as a consumer, but that's only a small percentage of Johnson & Johnson's overall revenue. The third reason dividend investors love investing in a Johnson & Johnson is because Johnson & Johnson has a wide economic moat. In order for a company to have a wide economic moat, there's typically 5 sources of sustainable competitive advantages that that company possesses. For example, in intangible assets, this could be maybe in research and development, for example. It could be a trademark, something special and unique to the business. Also, switching costs. For example, how difficult is it for a business to switch products? I'll give you an example. You have your shampoo. You maybe like the shampoo, but if the company or if the place where you get that shampoo is out of stock, you could always switch and try another shampoo from another brand. The switching costs are really, really important. This has to do more so with the medical devices and the pharmaceutical aspects of their business. The network effect, this is incredibly important. The cost advantages and the efficiencies of scale. One important factor of the economic moat with Johnson & Johnson is the amount of focus and resources that they're putting into research and development. Johnson & Johnson spent over $12 billion in research and development in 2020 alone, just around 15% of their total sales. This was over 7% more than what they spent in 2019. And to put this into perspective, the pharmaceutical business unit is where they're spending the majority of their research and development spend. And they've spent over $9 billion last year in research and development. And their nearest competitors, that's around 20 to 25% of their annual revenue of their closest competitors. So Johnson & Johnson is a cash printing machine when it comes to their business units, and they're really reinvesting into their core businesses. And you can see that by the amount of focus and resources that they're putting into research and development. The fourth reason why dividend investors love Johnson & Johnson is for the fundamentals that the business really sustains year over year. You can see that they're growing their revenue year over year. Their revenue growth percentage is right around that 6% range. It really depends on what time frame you're looking at, but they're growing year over year. And when looking at the dividends per share, you can see that they've grown the dividend per share year over year. So for example, in 2011, you would have gotten $2.25 for every share that you owned, compared to in 2020, you would have gotten $3.98 per share that you owned. The dividend yield has stayed just around 2.5%. That's the interesting thing about Johnson & Johnson. If you can invest into Johnson & Johnson with a starting yield of over 2.5%, you're getting an average dividend yield for this stock. And when looking at analyst forecasts into the future, if we were looking at 2022, you can see that there's an expected revenue growth of about 7%. And if you were to look at the dividends per share here in 2022, there would be an expected dividends per share of $4.71. Now we're going to take a look at Johnson & Johnson utilizing the FASTgraphs tool. FASTgraph is the fundamental analyzer software tool, and we can see the historical performance of Johnson & Johnson, how Johnson & Johnson has traded over time based off of its blended PE ratio, based off of its current dividend and its payout ratio. So the black line here is the price that Johnson & Johnson has traded at. The blue line is the average price that the market has demanded for Johnson & Johnson. The orange line is the average PE of 15. And the white line here is the dividends over time. This black line, what you'll notice is the black line goes up and down, up and down. But the white line, this is what is so important. The white line is going up and to the right. So when looking at this historically, the best time to buy Johnson & Johnson is when the black line is closer to the orange line or below the orange line, because this is the valuation. So when the black line is above the blue line, based off of historical performance, Johnson & Johnson has been overvalued. And Johnson & Johnson, as you'll notice, it trades typically between the blue line and the orange line. If you've been a shareholder of Johnson & Johnson since 2009, and you've held it all the way until today, you've experienced an annual rate of return of just over 11.5%. This is a really, really strong performance. Now let's say, for example, you weren't so lucky and you invested at the peak here in 2008, just before the stock corrected during the financial crisis. If you would have held all the way until today, you would have seen an annual rate of return of 8%. So the key takeaway here with Johnson & Johnson is depending on when you are purchasing Johnson & Johnson is when you're going to see the most optimal growth. If you're buying Johnson & Johnson when it's overvalued and when it's trading at a high PE ratio, you're going to see lower returns had you waited or purchased Johnson & Johnson when it was trading at a more favorable PE ratio. And when you look at the dividend cash flow performance of Johnson & Johnson, this is really the interesting thing that I was mentioning earlier. When looking over the last couple of years, if you look at the last 10 years, Johnson & Johnson has averaged anywhere from maybe a 5 to 6% dividend growth rate. But if you look back in the early 2000s, Johnson & Johnson was increasing its dividend over 10%. And this is what I meant earlier. When you look at the breakup or the weighting of the S&P 500, it's changed dramatically. So comparing the last 10 years of Johnson & Johnson, it's going to tell you a much different story than if you were to look over the last 20 years. And if you were to compare investing into Johnson & Johnson versus the S&P 500, if you would have invested into Johnson & Johnson in early 2001, you would have seen very comparable results. You would have gotten a lot more dividend cash flow from your investment, but your total return, the growth plus the dividend, would have been slightly under that of the S&P 500. So if you're a dividend investor and you're focused on the cash flow, investing into Johnson & Johnson versus just the S&P 500 would have yielded over $9,000 in dividends compared to just under the $5,000 in dividends from the S&P 500. So now that we understand the historical performance of Johnson & Johnson, let's take a look and see what the future potential returns could look like. If Johnson & Johnson continues trading at a PE of 17 to 18, we can reasonably assume what the total return will be year over year going forward. So for example, if Johnson & Johnson continues to trade at a PE of 17 or let's say 18, by the end of 2022, you could reasonably assume a 15.5% annual rate of return. This is actually really, really impressive. This is assuming that Johnson & Johnson has a PE of 18. Now let's say, for example, you held on to Johnson & Johnson all the way through 2023. With a PE of 18 through 2023, you can reasonably assume a total annual rate of return of 11.5%. And if you were to hold Johnson & Johnson all the way through the end of 2024, you can reasonably assume a total annual rate of return of just over 10%. So what would that look like if you held all the way to 2024, but Johnson & Johnson wasn't trading at an 18 PE, but it was trading more at a 15 PE? You would expect a total annual rate of return of just over 4.5%. So the key thing with Johnson & Johnson is really mostly when you're purchasing Johnson & Johnson. If you're buying into Johnson & Johnson at a high PE, you really have to reasonably lower your expectations of future growth. However, if you're buying into Johnson & Johnson at a lower PE, you can reasonably assume that you're going to get a much higher return over the coming years. So when calculating future performance with a stock like Johnson & Johnson, it really depends on the price point that you're purchasing and when you're buying into Johnson & Johnson. And it's really important you don't want to overpay for a company like Johnson & Johnson. This is even more important when you're lump sum investing and not dollar cost averaging into your portfolio. Johnson & Johnson may not be the flashiest company out there. It's not your Google, it's not your Tesla, it's not your Meta. It's a company out there that has been rewarding dividend growth investors for decades. It truly is a shareholder-friendly company. I hope that you learned something new in this video. I hope that this was helpful, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.